It's a pleasure to be here. My name is Belinda and I'm a senior economist at Commonwealth Bank. So I'm going to have a complete change of pace for you all right now. And in the next 10 to 15 minutes, I'm going to talk you through our view of the Australian economy. I'm going to talk all things interest rates, inflation, the labour market, consumer spending, and also the housing market, and then pass over to my colleague, Chris McCann. So at the moment in the Australian economy, there's kind of two different forces at play. We have an improving Australian economy because we have interest rate cuts. At the same time, we have President Trump. And global uncertainty, slower global economic growth, and really a lot of volatility in financial markets. So we're kind of going through this, in effect, war between an improving domestic economic cycle, but a lot of uncertainty coming from offshore. So when we look at what does that mean for the Australian economy, I think at the moment the domestic factors are winning out. We don't think the global situation is behind us. We think there's going to be more tariffs, more uncertainty to come, but a lot of that will be offset by lower interest rates in Australia. So it's about a month ago now that the Reserve Bank cut interest rates for the first time. We had that rate cut in February where, after rates being on hold for about 15 months, the Reserve Bank looked at the inflation data, looked at the weakness in the Australian economy and felt comfortable that they could lower the cash rate. Now, we here at CBA do think there will be further interest rate cuts this year. The chart up on the screen shows you our interest rate profile, which has 3 more interest rate cuts over the remainder of 2025. So that will take the cash rate down to 3.35%. Now, as you can see on that chart, it's actually a pretty shallow rate cutting cycle here in Australia. Some of you will remember prior to the COVID pandemic, interest rates kept going lower and lower and lower. The economy was very stagnant. We had low inflation, low wages growth, high unemployment. And a lot of the reason for that is because the federal budget, which is actually due in a week now, was trying to get back to surplus. So there was a lot of fiscal discipline at play and interest rates had to do the heavy lifting. It now looks like that situation is being reversed. The federal budget, the deficit's getting bigger. The government as a share of the economy is at close to record highs. So putting all that together, we actually think interest rates sit higher from here. So at 3.35%, that's roughly where we expect the average cash rate to sit going forward. It will still provide a boost to the economy though. Now, the reason interest rates are coming down is because inflation's coming down. Many of you will remember post the pandemic, we had this big spike in inflation. Inflation peaked at close to 8% at the end of 2022. Very different to where the Reserve Bank likes it, which is at 2.5%. But over the last 6 months or so, we've had much better news on the inflation front. You can see there the charts. On the charts, inflation is coming down. We expect inflation really over the next 2 years to average around where the Reserve Bank wants it at 2.5%. A couple of reasons why inflation's moderating. The first is the consumer's been weak. We've all been buying less stuff. Businesses are finding it harder to pass on higher costs now to consumers because of that weak environment. And going forward, we actually expect one of the most biggest factors will be what we're seeing in the housing market. So I don't need to tell you all about the rising construction costs that we've seen in residential housing and the broader construction sector in the last few years, but momentum is easing. So at the peak, construction costs for new homes was rising at about 20% per year. The latest data shows it's now down closer to 2.5% per year. In fact, some new builds, particularly for new house and land packages, builders are actually passing on discounts to get consumers to sign up. And the reason for that is households are starting to economise on housing. So we have the good old share house is back. People who took on that extra bedroom during the pandemic may be now getting a flatmate. And there's a lot of behavioural change in the housing market. So that's leading some improvements on construction costs, Rental growth is also easing as well, so advertised rents is coming down, and housing makes up about 20% of the inflation basket. So slower inflation going forward helps reinforce our view that interest rates will start to come down. The broader Australian economy has also been quite soft. So for the whole of 2024, the economy grew by just a bit above 1%. You have to go back to the 1990s recession for the economy to be this weak if you strip out the pandemic period. And what we actually saw was this big disconnect between what growth was doing and what growth per capita was doing. So another way to think about it, there's been two big tailwinds for the Australian economy in recent years. The first has been population growth, very strong net overseas migration, and the second big tailwind has been government spending. So we can see that clearly on this next chart. So what I have on the chart up on the left-hand side is I've put up all the different parts of the Australian economy that we look at. We have private business investment in blue. We have dwelling investment, so new housing construction in red, household spending in grey, and then public investment in green and public spending in black. You can see the difference even over the past 7 years, and if I did it over the past 2 years, it would even be more stark. So in effect, the only thing that's been keeping the Australian economy from growing in recent years has been expansion in government spending and investment. Now, a lot of that was needed. We kind of went through this very austere period through the 90s, the 2000s, the 2010s. We underbuilt on infrastructure, we underinvested in the care economy. There's been catch-up, but in effect, what it has done is crowded out the private sector in the economy, particularly the consumer. So high interest rates that we experienced over 2022, 2023 and into 2024 meant that household consumption has been really weak. In fact, when we look at household spending per person, and if we strip out inflation, it's gone backward for 8 consecutive quarters. So i.e., we've all been spending less. And that's been high interest rates, it's been cost of living pressures, and there's been a lot of divergence between what we've been willing to spend on. So there's been a lot of deliberate choices in spending behaviour. I've put up there on the chart on the right-hand side different categories. We've all been drinking less. It's probably not a bad thing. But over the last year, we've been spending more on household goods. We've been spending more on transport, going on holidays, recreation. Health is still there. We're making more deliberate choices in other categories. And one thing that we also know when we use CBA data is there's actually a lot of divergence by spending by age and spending by home ownership status. So when we look at spending by age, that's a chart on the left. And what it shows you is pretty much those under the age of 40, spending has been negative or close to zero. Whereas the older age groups, those over the age of 60, have been the ones that have continued to lift their spending. Now, I'm seeing a lot of nods in the audience. I'm sure none of you are actually surprised by this data, but what really surprises me is how stark the difference is. And this is even up until the December quarter, where we had 6 months of income tax cuts come through. We are expecting a consumer recovery this year, led by interest rate relief, but it is going to take some time to come through. And when I look at spending data at CBA the first 2 months of this year, it's been pretty flat as well. So it's going to take time. Consumers have chosen to save rather than spend. And as the chart on the far right is showing you, a lot of divergence between those who rent, which are generally younger, those who have a mortgage, which is generally the middle-aged groups, and those that own their home outright, where spending growth has been better. So when I think about the outlook for the economy, we're expecting interest rates to come down. We have inflation moderating. The wild card is what happens in the budget next week. We'll wait and see. And given we have a federal election, we are expecting some further spending announcements to come through. But one of the biggest puzzles for us economists in recent years has been the strength of the labour market. Now, we know there's a lot of worker shortages in particular industries. Health is at one of the top of that list. But overall, the labour market has been fairly tight. We've seen very strong employment growth over the last few years. The unemployment rate has barely moved higher. So generally, with an economy as weak as what we've seen, we should have seen pretty weak outcomes in the labour market. It's been the opposite this time around. So the unemployment rate troughed at 3.5%, now sits at 4.1%. We're actually not expecting it to lift too much from here, because a lot of the employment growth, as you can see that chart on the right, has been in that pink line, which is the non-market sector. So all the employment growth is coming from effectively 3 industries. Sure, you can all guess one of them. Health, education, and public administration. So over the last year, 80% of employment growth has been tied to sectors effectively tied to the public service. Now, this is really great. It's great for people, particularly women coming from outside the labour force into employment, paid employment, helping with a lot of cost of living pressures. But for economists like me, we are concerned that if this stalls and the private sectors are not hiring, then that's some risks around the unemployment rate. So we're watching developments quite closely. And I just wanted to flag, we are seeing some pretty outsized health employment growth in Australia versus some peer economies. So we've seen a big difference there, particularly to New Zealand, US and Canada. Just in terms of what we're seeing in wages growth though, for those of you who do hire and have to negotiate pay rises with your employees, we have started to see wages growth slow. So it peaked a bit above 4% around a year ago, but wages growth has slowed down to around 3.5%. We're expecting it to get down to about 3% by the end of this year. Now, one other point to make is even though the labour market is very tight, we're seeing a lot of employment growth, the pricing signals from the labour market are suggesting there's a bit more looseness in the labour market than what people expect. And we've actually seen a stronger fall in health wages growth than the broader economy. Just going to finish with the housing market. We did see home price falls late last year, early next year. Funnily, they started to turn around the 18th of February, around the time the RBA started cutting interest rates. So we are expecting home prices to lift this year by about 4%. There's upside risk given how quick we have seen an improvement come through the housing market. What we've seen is a turnaround happen most in Sydney and Melbourne. We've started to see home prices lift there, although as you can see on the chart on the right, still underperforming what we see in the mid-tier capitals. Generally, home price growth has been stronger in Perth, Adelaide and Brisbane, and also the regional areas, and we do expect that dynamic to continue just because of the affordability challenges. So when we look at housing affordability or lack of affordability, we have seen a dramatic deterioration in the last 5 years. So that is creating some more challenges around renting versus owning. We're seeing it push more into the older age cohorts as well. And we're still seeing this really big disconnect between population growth and the build of new houses. So the only answer to improvements in housing affordability in our mind is lifting the stock of available housing at all levels. In terms of population growth from here, we are starting to see a slowdown come through in net overseas migration. In particular, we're seeing a slowdown in things like student arrivals for universities and vocational education. That may well present some challenges for your sector, and also some fall in temporary skilled workers as well. So a tightening up of migration requirements and eligibility requirements, both here and Australia, have really started to deter some migrants coming in. And just a reminder, obviously we're seeing some big changes in the population age cohort as well. We're seeing that big lift in over 65-year-olds. We're also continuing to see a pretty big shift in population growth by state as well. So people are continuing to move out of New South Wales and into Queensland. That dynamic is not changing. Housing affordability is playing a big role there, but we did think it would settle down post-COVID, but we are really yet to see that shift. Now, that was a very quick 15-minute overview of the macroeconomic landscape. Please feel free to reach out afterwards. Otherwise, I'm going to hand over to my colleague, Chris McCram. Thank you very much.
Good afternoon, everyone, and thank you, Belinda, for setting the scene so well. For the astute amongst you, no, I'm not Brian Wong, as per the programme. I am Chris McCann, and I head up CBA's Health and Social Infrastructure business across the bank's major client group. And I do recognise, I know it's been said before, that I am between you and lunch, so I will keep my remarks quick, but not too quick, or I risk slipping back into broad Glaswegian, and I don't have subtitles. Whilst not lucky enough to have been born in Australia, in the privileged 20 years that I have lived here and raised my family, I've learned that Australians have been raised in the promise of the great Australian dream. But for many of our critical workforce, that dream is starting to feel more like a bedtime story and perhaps more of a recurring nightmare. Second only to energy transition and geopolitical risk, the cost of living crisis and housing affordability crisis is the biggest challenge facing Australia today to sustain economic growth. We're living longer, as we've heard, which is tremendous, but it also means that we need somewhere to live for longer. The problem, as we've heard, more Australians are carrying mortgage debt into retirement, struggling with insecure rental tenures, and alarmingly facing homelessness in their senior years. And let's be honest, a share house in your 70s and 80s is a little less of a fun social experiment and a more of a cross between Survivor and Big Brother. On top of that, Australia's $250, $300 billion, depending what you include in that, aged care and NDIS health and aged care system is bracing for a fourfold increase in the number of people turning 80, as we've heard from many of our speakers today, placing extraordinary financial pressure on young taxpayers, patients, and health and service providers alike. And add to this, 31% of Australians are renters, and alarmingly, this is growing year on year, meaning a significant proportion will reach retirement without the security of home ownership. Unlike those who can sell a family home and release equity and buy into a retirement village or a land lease community or aged care, these retirees have limited options. So where do these hard-working Australians go in retirement? Without investment in affordable housing and alternative retirement products, which we've heard a lot today, many will face serious financial and housing insecurity in later years. So how did we get here? And I know this has been covered a lot, and I know you're hungry, so I will be quick. Decades of underinvestment in affordable housing, senior living, and aged care, falling home ownership rates, rising housing costs, and a private rental market that's about as secure as a toddler with an ice cream cone. The results, a system-wide failure where housing insecurity isn't just a young person's problem, it's everyone's problem. And the health and aged care system is struggling to keep up, one that will soon face a crisis of bed blockers and a severe shortage of aged care facilities, doctors, nurses, and care workers. So why does this all matter to the economy? Housing stress doesn't just keep people up at night. It slows down the economy, as we've heard from Belinda. When people are spending more of their income on housing, they're spending less everywhere else. Less spending, less growth, less opportunity, and less investment in other sectors for future growth. And the social return on investment in affordable housing is significant. Research commissioned by Housing Australia in 2023 found that for every dollar spent on the delivery of social and affordable housing, the Australian community saves $2 in future costs related to health, social assistance, and justice. And of course, stable housing is critical for workforce participation by providing dwellings in proximity to education, amenities, employment, and better opportunities, all of which provides aspirational pathways to realising that great Australian dream of owning your home one day and retiring well, buffered by the equity in the family home. For many operators in the room, this will resonate deeply. around the challenges of securing accommodation for your essential care workers in proximity to your villages. Given this, it will be increasingly challenging for Australia to continue to be the recession-proof economic phenomenon if our maturing workforce is too busy couch surfing. Meanwhile, strong demand for healthcare workers has drawn talent away from other sectors, contributing to productivity declines, as we've heard again from many of our speakers today. Health, aged care, and the NDIS are one of the fastest growing areas of cost to government, and without structural reform, the pressure on younger taxpayers will only intensify. And this is starkly apparent, and it was touched on just quickly earlier today, when we're looking at the forecast aged care dependency ratio. And just to be clear, that's the measure of the number of people aged over 65 for every 100 people of traditional working age. And that's expected to hit close to a staggering 39% by 2065, from 26% today, which is clearly not viable. So CBA's, look, I just want to talk quickly about CBA's approach and how we're sort of thinking about this as a bank. As the largest bank, we recognize the imperative of being part of the solution. We're not just here to hand out mortgages and provide you with incredibly attractive term deposit rates. Yeah. Speak to me afterwards. We also want to help build a more sustainable housing future for both working Australians and aging Australians alike. This means investing in affordable housing, supporting innovative retirement and aging models, like we just heard from our last few speakers, whilst working alongside government, industry, and your amazing organisations to innovate and create real change. CBA's major client group has recognised health and social infrastructure sectors as priority sectors for future growth, with land lease communities, retirement villages, aged care, social and affordable housing, and specialist disability accommodation identified as the 5 key strategic pillars for investment in future housing and retirement living capacity, supported by strong risk and executive alignment across the bank. Underpinning this, during 2020, CBA launched its $70 billion sustainability funding target, with a commitment to deploying bank capital into focus sectors, which includes, amongst other asset classes, affordable housing, disability accommodation, retirement villages, aged care, and hospitals, to deliver a positive impact on the economy far into the future. And we're making great progress towards that 2030 target, with $54 billion deployed as at 30 June last year. And innovation, as we've heard from all of the operators today, is key, and it's certainly central to everything that CBA is doing. I'll just touch on a few of the things that the bank has been focused on. Earlier this month, you may have seen that we were the first bank to offer aspirational homeowners construction finance on prefabricated homes with loans of up to $1.5 million. CBA is also the largest participant in the Home Guarantee Scheme and has helped over 65,000 Australians buy their first home with a deposit of as little as 2% with no lender's mortgage insurance. The bank has also partnered with Coposit, which allows first-time home buyers to purchase off the plan with a deposit of as little as $10,000 without having to part with 10% of the property value years in advance of entering the home. And we're actively working with community housing providers in every corner of the country, supporting round 1 of the Housing Affordability Future Fund that will deliver 13,700 homes to many of your critical workforce. The housing and ageing crisis isn't an unsolvable problem. It's a challenge that requires bold action, smart policy, and serious investment and innovation. And the private sector, with the backing of institutional capital, will be integral in achieving this. We must continue investing in housing solutions that provide stability for all Australians, regardless of age. We need to rethink aged care models, moving away from outdated systems to a more flexible approach that embraces at-home care, assisted living, integrated healthcare hubs, and better use of allied healthcare professionals. And we all have a role to play, government, private sector, not-for-profits, banks, to build a deep and sustainable institutional capital-backed asset classes across affordable housing and all aspects of healthcare, retirement, and ageing, to curtail the blowout in government spending and lessen the burden on Australian taxpayer, working Australians rather. Positively, as we heard from Belinda, with build costs stabilising, inflation moderating, rate cuts on the horizon, and increased government stimulus, we are starting to genuinely see an uptick in viable development feasibilities continuing across land lease and retirement, but positively across aged care as well, which we haven't seen for a number of years. And this is really encouraging, and it's supported by strong alignment with CBA's risk appetite to bank these critical sectors through the cycle. Joining me in the room today are about 15 of my colleagues, including some of my risk colleagues who I've just put on the hook as well. So please reach out to us to discuss how we could be supporting your businesses to invest into the future, to ensure that the great Australian dream does not become the great Australia dilemma. Thank you.
Thank you very much, Chris. And obviously, we do need the bankers' support. And one of the benefits of this sector is that we do have bankers who are committed to the sector. I mean, you have 15 in your team here dedicated today?
I believe there's about 15 of us. Yeah, we come on safety of numbers.
Yeah, CommBank has been a very strong supporter of the sector throughout, and as you say, with a very open mind.
Yep, absolutely. We're very much addressing the healthcare crisis as a continuum of living and a continuum of care, and that's the approach we're taking right through, from working Australians through to retiring and aging Australians.
So can we show our appreciation? Thank you.